Welcome to my retirement resource. Hi, thanks for joining me. I am Wayne Wilsinski, and this is the Retirement Question and Answer podcast series on how to take control of your retirement. My goal is for you to better understand your retirement finances and to have the confidence to better manage your advisors and your retirement nest egg. The topic today is estimating income taxes, what you need to know. Why is this important for retirees? Many retirees have less taxable income in retirement than when they were working full-time. Also, your lifestyle changes, which affects the expense deductions you can take or not. Lastly, of course, in retirement, money is not withheld on much of your income, so you must pay taxes on an estimated basis, either on the payment due dates or as the income is realized. What do you need to know? Here are 5 questions from our listeners. Who? Do you need to pay estimated income taxes? When? When are the payments due? Why? Why? To avoid penalties, of course. And what's new in 2020? And how? What can you do to reduce your taxes? All right, let's answer the first question. Do you need to pay estimated taxes? Well, the answer is yes if both of these apply. Number 1, if you expect to owe at least $1,000 in tax for 2020 after subtracting withholding and refundable credits. And number 2, your withholding and refundable credits will be less than the number of the following: 90% of your estimated 2020 tax on your return, or 100% of the tax shown on your 2019 tax return. This is the safe harbor rule which applies. So again, both number 1 and number 2 need to apply, and if they do, then you need to pay estimated taxes. In retirement, of course, the concern is that you do not have withholdings on investment income or other income such as IRA distributions. However, since you did not withhold, you do have to pay taxes on that income on an estimated basis as that money is realized. Now, there are some exceptions that may apply to you. The percentages may be different if you're considered a higher income taxpayer. Cover that in a second. You are a farmer or fisherman, or you are a U.S. citizen for all of 2019 and had no tax liability for the full year. So who is considered to be a higher income taxpayer? Well, if your 2019 adjusted gross income, which is line 8B of your 2019 tax return, if that amount was more than $150,000 if you file jointly, $75,000 if your filing status is married filing separately, then you would substitute the 100% with 110%. So again, it would be the smaller of 90% of your estimated 2020 tax return or 110% of last year's tax return if you're considered a higher income taxpayer. When are the estimated payments due? Well, here's the deadlines for 2020. And this is a modified payment schedule due to COVID. July 15th, hopefully you made your first and second estimates. The next deadline is September 15th, which would be your third estimate due date. And then the last payment is January 15th of next year, which would be your fourth estimate payment. Now again, you want to avoid penalties. If your adjusted gross income is greater than $150,000, pay 90% of 2020 and 110% of 2019. The penalties are large. Late filing is 5% of the tax owed each month up to 25%. The penalty for paying late is 0.5% for each month that you've paid late. Late filing and late payment is 5% up to 25%. To find out what's new in 2020, visit the tax section at myretirementresource.com. I have several blog posts and other podcasts on this subject that will detail out for you what is new in 2020 and see if it applies to you. Number 5, reduce taxes. Here are a few tax tips for you. As we stressed earlier, avoid the penalty, pay, and file on time. Don't forget to include unemployment if not withheld. And note that your stimulus checks based on 2020 income may generate income even though you did not qualify in 2018 or 2019. Consider delaying the taking of your RMDs this year. The government is allowing this in 2020 if you're over 72 years old. as you may have in the past, add to your tax-free and or deferred accounts where possible. Pay into your 401k if that is in your strategy. Bunch your itemized deductions. There's a higher standard deduction limit, so your ability to itemize has changed. If you bunch your itemized deductions into 1 year, the total of those deductions may exceed your standard deduction, and therefore you would have more deductions than otherwise. And lastly, harvest your capital losses. I hope you've enjoyed this podcast. Please don't forget to visit me at myretirementresource.com to see many blog posts and other detailed information on a variety of subjects about your retirement. All the best to you and yours, and happy retirement.